How good are credit analysts in making predictions about a small firm's defaulting on its obligations? How good are they in making analytical predictions as opposed to statistical predictions? This is definitely the book you want if you want to answer that question. If you're a small business owner and you're applying for a loan, you're likely to be adversely affected by a subjective judgment relating to your business prospects. Whenever an expert judgment is involved in making a prediction, it is well documented that a bias will occur at any level of expertise. I wanted to answer a question from one of you about how good banks are in making predictions about the default of a small firm. I think this firm is too weak to be granted a loan, says a credit manager at the local bank. In my opinion, this business will have no future, neither in the long run nor in the short term, is the final remark of a credit analyst before rejecting a loan application. This company's business model hasn't been proven so far. Thus, we cannot originate a loan, is the ultimate verdict of a bank employee. Some of the evidence against expert judgment in forecasting future events is provided in many award-winning pieces of research, as well as in international bestsellers authored by internationally recognized Nobel Prize winners. For instance, Daniel Kahneman, in his enlightening book Thinking Fast and Slow, writes, "Why are experts inferior to algorithms? One reason is that experts try to be clever, think outside the box, and consider complex combinations of features in making their predictions. Complexity may work in the odd case, but more often than not, it reduces validity. Simple combinations of features are better. Several studies have shown that human decision makers are inferior to a prediction formula even when they are given the score suggested by the formula." Another reason for the inferiority of expert judgment is that humans are incorrigibly inconsistent in making summary judgments of complex information. When asked to evaluate the same information twice, they frequently give different answers. Is human judgment a good predictor of default when it comes to small businesses applying for a loan? Is an analyst's credit opinion capable of considering complex information contained in hundreds of pieces of information and data? How accurate is an economist's forecast about an impending interest rate increase? These are the questions economists and psychologists together have tried to answer, while carrying out hundreds of scientific experiments whose outcomes pretty much point in the same direction. We are in fact misguided by our intuition. When we convey an opinion, express a prediction, or assess the value of a future event, we think we are guided by sharp and flawless intuitions, whilst indeed what's driving our thinking might be blunt and flawed biases. Analytical prediction versus statistical prediction. Over the years, I have had the privilege of meeting several thousand people in traditional classroom settings and have collected hundreds of data samples from them in the form of surveys, which I've used and still use to present topics about a specific subject or to highlight some examples in general. The data I'm going to use stress how flimsy and fragile and unreliable are our forecasts about future events. Sensitivity is the percentage of firms correctly classified as yes default. And specificity is the percentage of firms correctly classified as no default. And accuracy is the percentage of firms correctly classified either as yes default or no default. You have good predictive skills if these statistics are high. The higher, the better. This is my algorithm. with its sensitivity and specificity and accuracy. It's hardly beatable from expert judgments. And this is the expert judgment's prediction. Sensitivity and specificity are respectively 45 and 56%, whereas accuracy is only 54%. These credit analysts were very confident about their predictions. And what happened? They got beaten by a simple algorithm, one built on two predictors. I said two predictors. Financial ratios available 12 to 18 to 24 months before. This is definitely a great book. It will probably shake the way you think, the way you look at the world around you. It will probably shake the foundations of how you think about yourself, especially when making decisions, when making predictions. Anyone who would like information about how misguided is our intuition, anyone who is interested in understanding better how we think should read this book. This is a great book. You think about yourself, especially when making decisions, when making predictions. It will probably affect the way you are confident about many small little tasks that we try to carry out and we carry out every day. This book will change the way you live your life. It's not an easy book. It's not an easy book. Not at all. You have to read it slowly. You have to digest it. And it will make you reconsider the way you approach decisions, especially important decisions, I think. Thinking Fast and Slow by Daniel Kahneman. And I recommend to read it. Go through this book. It's great. Read it, okay? Read this book. It's great. It's important. Bye.